Good evening, Doc Severson here with the TheoNight Report for Thursday, March 8th. Let's look around the various markets for a minute before I go over to the S&P 500 and look at where that is going, as well as other markets that we have, such as the Russell. Right now, the 10-year note is holding steady right around 2.8, 2.9%. This is no doubt a very bullish flag pattern setting up here, and this is turning into a weekly flag because we have this exhaustion level here on the weekly chart. And so I would expect to see consolidation here setting up for some time. We have at least another 2 weeks to wait before we have the next Fed meeting. And of course, that Fed meeting, we are sitting here at about an 88% probability, 88 to 89% probability that that rate hike is going to happen. Another quarter point rate hike. And then as we start to get out through the various other important ones, we start to see the probability now 69% of another quarter point rate hike in June. We start to get out to September, and we see that there is almost even odds on another quarter point rate hike at that point. So we can start to see the writing on the wall, at least lately, in terms of a rising rate environment. Again, normally that's not a big deal, as we saw back from 2003 to 2007. We certainly had a market that rose during a rising rate environment. But back then we didn't have anywhere near the debt payments that we have right now. So those could be a real drag on things as we start to raise rates. Here is the dollar chart. We don't look at the dollar chart all that often, so we'll watch for this to occur. Lately, we've been seeing the dollar just moving strongly to the downside, which is going to help some of those companies that are multinationals sell more overseas, although this makes it much more important that we watch this now with the upcoming tariff war, which could be in place pretty soon. Here is the TLT, which is just an ETF of the 20-year Treasury bond. And this is forming a very extreme lower high sitting up on the monthly chart. So we can start to see this moving here. Okay, so all of this is now breaking to the downside with a monthly lower high. And so Bill Gross called this quite some time ago as a bond bear market, and now we're definitely into that. I think a lot of people are still expecting a big bounce up if we start to see weakness in equities. But again, the underpinning of a rising rate environment may put more and more pressure on this particular market. And lastly, before I get to the S&Ps, here's the volatility market right now. And it has not formed this is a lower high, but it hasn't formed a lower low yet. So right now there is still this sort of impending sense of doom out there that people are keeping their hedges on in this environment. And with good reason, because as we'll see in the S&P, I believe that we are still looking at seeing months of volatility yet to come. Okay, so here's the S&P, and if you've followed my corner for any length of time, you know that this is a historic level of exhaustion that we're seeing on the monthly chart. So until recently, we also had that same signal on the weekly chart. The market is doing exactly what it needs to do to work this signal off. Almost as if you had dropped a ball off of the top of a large statue or something. You're going to see it bounce back up again, bounce, bounce, bounce. What we're working towards is what I believe will eventually be some form of triangle formation here, as the price will probably oscillate within here. We've already seen this a couple of times so far, right? Just in the space of a couple of weeks, we've seen this strong sell-off, a great rally from there, and then we saw several days in a row last week where we just could not get a bid. Or we'd start off in the morning and then all of a sudden the trap door would open up. And then this week we've seen a bounce as we've gotten a little bit of certainty. People have gotten their heads wrapped around this whole idea of a trade war and tariffs and things like that. Again, market's always going to react based on certainty. But now we have some overhead obstacles. So this trend line, while it doesn't exist in real life, it's still a very obvious level. And the expression is, in a sea of sand, a single flag that sticks up will become a target. And so I wouldn't be surprised to see us punched through the 50-day moving average, which is this red line right there. So I'm not a big believer in using moving averages as levels of support and resistance, although we can see sometimes they do get tested just because of the same theory, right? If there's nothing else, this becomes a single target. But I think we'll probably have a tough time the first time through that 50-day moving average. For that to break above there and to form a higher high, I think would at this point be a very difficult thing. So far, what I'm seeing on the price action here is that we went into an uptrend here, higher low, higher high, and now we've gone to a lower low. So that increases the probabilities that the next high will be a lower high and that perhaps we roll over. What I've also talked about recently is the fact that normally a retest of the lows when we have an initial shot over the bow like this normally takes about a month to 6 weeks or so for this to show up. So having this coming down here again within the span of the next couple of weeks would make a lot of sense. So are all these things going to happen just because I have a bunch of lines on my chart? Well, of course not. So right now, if I do see, what we can do is we can sort of box in the price action like we always do. Right, so we can box this in. It's a very large box right now. That makes it a problem. But if the price does actually punch through there, then the odds have improved that we're going to see a retest of the highs. Otherwise, if we see the price cannot get through this trend line and instead rolls over, then the odds have improved. I don't know if we're exactly going to get a retest of the lows or maybe even an undercut. I would certainly say somewhere at least to the 2600 level would be very fair at this point, but those could be certainly in line right now. So one last comment on the news is that this is what we're seeing right now is very, very common to a corrective market, where over the last, I'd say the last 9 years or so, every bit of bad news has turned into a rally, right? Why is that? The reason for that is because bad news means that rate hikes are going to be delayed. And this has been the case for the last 9 years or so. So bad news is good news for the market. And then good news, of course, is generally perceived as good news. So the market was in kind of a no-lose situation over the last 9 years or so, really since the mid-2009. We've been under this sort of bad news is good news condition. Now we're starting to see quite the opposite. This is a real character change where now good news is perceived in a negative way. Why? Because of rate hikes. All of a sudden, we don't have any tolerance for rate hikes, even though they've been threatened on the table and probably overdue for quite some time. So the Fed giveth and the Fed taketh away. Now, one last thing to look at, here is the Russell. The Russell has actually moved back into a primary uptrend with a higher high, higher low, higher high combination here. And so this is actually showing a potential for a retest of the highs. One of the reasons for the Russell strength has been the fact that these companies are less susceptible to a potential trade war. The other caveat, though, is that Russell companies are more debt financed. So if rates do go up, don't just assume that the Russell is going to go screaming higher from here. It's going to be more difficult on these companies from a bottom line perspective. Okay, folks, that is it for today's report. Thanks for listening. We'll see you tomorrow.